Hej och välkommen till Börslunch Special. Det är torsdag den 2 mars. Ja, det är dags att prata räntor och makro. Idag har vi med oss en global förvaltare. Han är en man som kan mycket om det mesta. Vi ska ta en titt på makroläget idag, räntemarknaden och hur den kommer påverkas av lågränteläget framöver. Welcome, Gerhardt Herbert.
Thank you.
You're a portfolio manager and head of global credit at Brandywine Global. Could you tell us a little bit about what you do in your position?
Sure. Brandywine Global is a global fixed income firm. We're actually based in Philadelphia, but with a very significant international client base. We're known as one of the premier, non-benchmark-oriented value fixed income managers that looks for opportunities across the spectrum in global securities. So it may be traditional sovereign bonds, emerging market, corporate credit, as well as currency markets. We try to find value in each of those portfolios or in each of those sectors and then drive portfolio construction decisions to outperform benchmarks over the full business cycle. And
you mentioned some different credit markets. Where are you seeing value right now?
We see distinct value in 3 markets currently. I'd say the biggest valuation anomaly for us is in the emerging markets. Particularly emerging markets, local currency sovereigns is where we see value. The second segment of markets where we see distinct value is in high yield and investment grade. So broadly speaking, the credit markets for us offer distinct value. I would say, importantly, though, we see the significant value proposition in U.S. credit instruments relative to Europe. Europe was a segment of the market that we had been significantly exposed to over the last 3 years. However, with yields, particularly in the European high-yield market, hitting all-time lows, we've been favoring opportunities in the U.S. investment grade as well as the U.S. high-yield market.
You talked about U.S. and Europe. Are you seeing any opportunities in maybe Asia right now?
In Asia, we do see some distinct opportunities. They would be obviously more credit-oriented and typically in the more cyclically oriented sectors. So whether it's a commodity or heavy industrial, that would be a particular opportunity for us in our strategies. As well, areas where we would see opportunities in local currency sovereign bonds. So if one would want to consider opportunities in Indonesia or even India, for example, we would think that that would offer significant value.
So how do you, as a portfolio manager, invest in these opportunities?
Well, we have a unique approach, and I think that's one of the things our clients depend upon us to define is where are there, in fact, value opportunities using a disciplined approach. Our approach utilizes top-down and bottom-up research. We analyze opportunities across sovereign markets, currency markets, and credit markets based on our valuation parameters, and we look for where there are significant valuation anomalies. So typically what we try to identify are markets that are statistically cheap, that is 1 or 2 standard deviations cheap relative to history, and where we see a structural or state of the economy turnaround happening.
So we talk a lot about high yield emerging markets, but what risks do you see in these markets?
I think the real risk that we see is if, in fact, the U.S. economy and the global economy is moving from secular stagnation to stronger growth, there is the potential for higher interest rates and, in fact, shrinking central bank balance sheets over the next several years. That, to us, would be a risk. However, if the economic impulse caused by improved fiscal policy, caused by animal spirits in the broad-based developed market economies picks up, that should be able to offset higher interest rates and smaller balance sheets at central banks.
So expectations are that interest rates, at least in the U.S., will rise this spring. How's your outlook right now?
Our outlook is, in fact, that they will rise. The market that we typically try to follow is the inflation swaps market. The inflation swaps market is indicating that we should anticipate at least 2 interest rate hikes. I don't believe the 3rd rate hike is necessarily embedded in the market. So we see rates rising, but a relatively benign or accommodative environment for rates going forward, which would really support the markets where we see value. So local currency emerging markets, particularly focused on the Latin American regions, as well as the credit markets, investment grade and high yield, focused on the U.S. And as an unconstrained fixed income manager, we have the ability to take advantage of all of those opportunities across all of our distinct fixed income strategies.
Do you see any possibility or risk that Donald Trump as president may interfere with Janet Yellen's policy and rate hikes?
There's certainly a lot of risk around this new administration in the U.S. Traditionally, there has been a separation of input, if you will, between the president and monetary policy. We think there's a bigger risk a year or so from now when Yellen is replaced with a head of the central bank that fits with more of his perspective in terms of a more rules-based or more dogmatic, if you will, monetary policy environment. But we would argue that that risk would be a year from now rather than the short term with Janet Yellen or Stanley Fischer.
Right. Your fund had a double-digit performance last year. Do you see any signs of that we're seeing a global credit bubble right now?
I actually don't think we're seeing a credit bubble. I think we're well aware of weakening covenant quality and expanding issuance in the below investment grade space. That's a sign of, I would argue, concern, but we don't see deeply speculative conditions like we saw in 2005 and 2006. We've been in a period of significantly lower growth over the last basically 8 to 12 years. The concept of secular stagnation, I think made popular by Larry Summers, has been a real concern. And what we see, in fact, is actually improving economic growth. One of the most important charts that we've been able to identify, or data points that we've been able to identify, is that small business optimism is really improving in the U.S. And that small business optimism typically drives growth and demand for credit. So even though credit conditions are significantly easier than in the past, we don't see a bubble territory, and we think this cycle will be more extended than it already has been. So this is a very non-traditional cycle brought about by unorthodox monetary policy, but we're now making the handoff from an unorthodox monetary policy to more aggressive fiscal policy, which should continue to allow the credit markets to expand and credit spreads to tighten, but nowhere near bubble territories in our estimation.
Very interesting. Thank you so much for coming here, Gerhardt. Imorgon är det dags för oss att sammanfatta rapportperioden. Det gör vi tillsammans med Erik Hansén som vanligt har med sig massvis av spännande grafer. Missa inte det, och tack för att ni har tittat.